Krishna, another factor of the last couple of weeks has been a sell-off in FANG names and tech stocks. You see that as a buying opportunity? Well,
yes, but let me first address the issue that Mohamed raised, and I think it's an important one. While liquidity remains an issue for the market, looking at the repo rate spike as a proof point for that, I think it is making an exaggerated statement, because this really has a lot more to do with big banks hoarding reserves because they use it for regulatory purposes. This is a solvable problem. We can blame the New York Fed for not anticipating it, but at the end of the day, it is really not the end of the world the way it is being made out. As far as tech stocks are concerned, I think at the end of the day, when the U.S. economy is growing at 2%, people are going to pay fancy prices for companies that can deliver significantly higher growth rate in their revenues and cash flows. And I think while we may be taking a bit of a pit stop with respect to them, eventually tech stock is where, if the market is going to go up, tech stocks have to go up.
So in terms of the fears on liquidity, how concerned are you about that? Because you also like credit at the moment.
Yes, and I think if you look at the concerns with respect to the repo market and what the implications of that was in the credit markets, it really, we basically looked at it and said, okay, well, the Fed will solve this problem and go away. And I think that is the reality. This is a very nuanced issue with respect to reserve hoarding by banks. The Fed can solve that problem. The easiest thing that they can do is to reduce the interest that they pay on reserves. They do that, the demand for reserves goes down meaningfully. But that has implications for bank profitability.
So, Krishna, the easiest thing for anybody to do is to talk about every item as an isolated item. So let's go look at the list of items that we're now treating as noise, which is what you basically said. Forget the disruption in the repo market. Forget the 16 trillion of bonds trading at negative yields. Forget the fact that we are deglobalizing the global economy. I can go through a whole list of things that you and I would have thought were unthinkable 4 years ago. They've all happened, and the tendency in the marketplace is to treat everyone as a standalone, containable issue, but we're ignoring signals. And I would tell you, what we're hearing is not just noise, it's signal that the system's under stress.
Look, Mohamed, there are significant issues in the global markets. The biggest of them is the slowdown in the global economy. At the end of the day, that is really the core problem. Negative rates certainly help, they don't solve the problem, but they soften the blow of that negative growth. And at the end of the day, maybe at the margin, increase things a little bit. So the kind of looking at repo market issues and kind of conflating that with everything else that the global economy is facing is a bit of exaggeration. That's the point I'm trying to make. Deglobalization is a very significant issue. It's not going away anytime soon. I think, in my judgment, we have probably seen the peak of globalization. So that, from an economic growth standpoint, that is going to be a drag on the global economy for a long period of time.